Hello, and welcome to this session over general health insurance licensing. So first, we want to cover just some general insurance. At the beginning of this chapter, there are some terms that you will need to know. So I have those bulleted for you here. But next, as far as knowing definitions is really important for your test. So some key terms to know. First, you need to know what is insurance. Well, insurance is the transfer of risk. The whole reason there is an insurance mechanism is we are transferring the risk of a loss to an insurance company, whether that be life insurance, health insurance, or even car insurance. It's all about transferring the risk of a loss to the insurance company. As far as risk is defined as the uncertainty or chance of a loss occurring. There are two types of risk. There are pure risk, which can result in a loss or no change, and those are the only ones that are insurable. Then there are speculative risk, involves a chance for loss or gain. When you think of speculative risk, think of gambling. There is not an insurance policy if you are a gambler that will cover your losses. So speculative risk are not insurable. Next, we have exposure. Exposure is a unit of measure used to determine rates charged for insurance. Some things that are important when they determine the rates charged are going to be the age of the insured, medical history, occupation, and sex. Next, we have hazards. Hazards are conditions or situations that increase the probability of a loss occurring. There are three different types of hazards: physical, moral, and morale. Let's start with a physical hazard. Physical hazards are going to be something like your past medical history or possibly blindness are examples of something physical that would be considered a hazard. Moral hazards, think of your morals, tendencies towards increased risk. Think of somebody that lies on their insurance application or submits fraudulent claims. Okay, that's their morals at work. So that is a moral hazard. The next one is very similar, called a morale hazard. Now, this arises from a state of mind that causes indifference to a loss, such as carelessness. So for your test, just think of somebody that is texting and driving. Okay, they are being very careless when they are doing that. Okay, that is a morale hazard. A peril is the cause of loss. Life insurance insures against the financial loss by the premature death of the insured. Health insurance insures against the medical expenses and or loss of income caused by the insured's sickness or injury. Next, we need to know what is a loss. A loss is defined as the reduction, decrease, or disappearance of value of the person caused by a named peril. Insurance provides a means to transfer that loss to the insurer. So please make sure you're familiar with all of these terms: insurance, loss, perils, and then hazards. And hazards are conditions and actions that increase risk or probability of a loss occurring. Methods of handling risk. There are a few different methods. First, there's risk avoidance, where you're eliminating exposure to a loss. Example, to avoid the risk of being killed in an airplane crash, you choose not to fly. Next is risk retention, which is the assumption of risk by an insured through the use of deductibles, co-insurance, and self-insurance. The purpose of retention is to reduce expenses and improve cash flow, and also increase control of claim reserving and claim settlements, and to fund losses that cannot be insured. So if a loss cannot be insured, then that person or company is retaining that risk. Next is risk sharing, which is a method of dealing with risk for a group of individuals or businesses with the same or similar exposure to share in the loss that occurs. A reciprocal insurance exchange is a formal risk sharing arrangement. Next way of handling risk is risk reduction, which is attempting to lessen the possibility or severity of a loss. For example, installing smoke detectors in your home, you're reducing the chance of your home burning down. Or having a yearly physical, when we talk about health insurance, you are reducing the chances of you being sick. And the most common way is to transfer risk. This is the most effective way to handle risk so that the loss is borne by another party. Insurance relieves the insured of the financial losses these risks bring. Next, we need to know the elements of an insurable risk. So for a risk to be insurable, it has to have these elements. First, the loss must be due to chance, something that is outside of the insured's control. Next, the loss must be definite and measurable, loss that is specific as to the cause, time, place, and amount. Next, the loss must be statistically predictable. Insurers must be able to estimate the average frequency and severity of future losses to set appropriate premium rates. Next, the loss must not be catastrophic. Insurance policies exclude loss caused by war or nuclear events. And then next we have loss must randomly selected and large loss exposure. What that means is there's the law of large numbers. Insurance is all about the law of large numbers. They have to insure a whole lot of people for the numbers to work out, and represents a random selection of risk in terms of age, gender, occupation, and health. This next term is very important for your test: adverse selection. Now, adverse selection are risks that are more prone to loss, tend to seek out insurance more than the average risk. The way I would like for you to memorize it is sick people who are trying to commit fraud. That is adverse selection. And I'll talk more about adverse selection later on when we get into underwriting. Next, different types of insurers. There are private insurance companies, and then there's government insurers. Now, private is pretty much any insurance company you can think of. Private insurance companies are funded by premium dollars. Now, government insurance, think of Medicare, Medicaid. Those are funded with tax dollars. These next two, I need you to be able to separate for your test: stock insurance companies and mutual insurance companies. And here's what you need to memorize about each one. First, stock insurance companies are owned by their stockholders. Stock insurers are called non-participating. And the reason is the policy holders do not participate in the gains of the company. Now, if that stock insurance company makes a profit one year, they can share it with the stockholders in the form of a dividend. But you do need to know right away that dividends are not guaranteed in a policy. And then if there is a dividend, however, that dividend is taxable to the stockholder. Just like if you own stock in any company, you are taxed on any dividends you get. Mutual insurers. Now, mutual, like Mutual of Omaha, owned by its policyholders. Mutual companies are called participating because the policyholders participate in the gains of the company. So let's say you have a policy with Mutual of Omaha and they have a dividend, they make a profit one year. So they can pay dividends to the policyholders, but once again, remember, the dividend is not guaranteed. But in this case, if there is a dividend, that dividend is not taxable to the policyholders. The reason it is not taxable is it's considered a return of any unused premium that they had paid from the year before. So please make sure that you memorize stock and mutual insurers. Next, we have fraternal benefit societies. They provide insurance benefits to members of an affiliated lodge, religious organization, or fraternal organization. They are considered charitable institutions. Lloyd's associations, not an insurance company. What they do is they provide facilities for underwriters or groups of individuals that accept insurance risk. A captive insurance company is owned by a corporation or firm and to serve the parent organization's insurance needs at lower rates. So that's important that they are serving the organization's insurance needs at lower rates. Next, insurance companies, to do business in a state, they have to have what's called a certificate of authority. That certificate of authority is issued by the Department of Insurance. It is a special license that insurance companies must have to do business in the state. If an insurance company has a certificate of authority, that means that they are authorized or admitted to do business in the state. Because if they do not have a certificate of authority or have been denied one, then they are unauthorized or non-admitted. Next, insurance companies themselves are classified by their location of incorporation. And this is pretty easy. If they are incorporated in the state that they are doing business in, then they are a domestic insurer. If they are incorporated in another state, but doing business in this state, then they are a foreign insurer. If they are incorporated in another country, but doing business in the United States in a certain state, they are an alien insurer. So domestic is in state, foreign is out of state, alien is another country. Next, we have reinsurance. Reinsurance is a contract under which one insurance company, the reinsurer, indemnifies another insurance company for part or all of its liabilities. The whole purpose behind reinsurance, it protects against catastrophic losses. The ceding insurer gives the risk to the reinsurer. The assuming insurer takes on the new risk. Next, we have producer and general rules of agency. So an agent is called a producer. The agent negotiates insurance contracts on behalf of the insurer. Agents are deemed to represent the insurer, and that will be important for your test that you know agents always represent the insurance company. The agent is responsible for accurately completing the applications for insurance, submitting to the insurer, and delivering the policy. Next, as an agent or producer, there are certain authorities or powers that you may have. The first type is called express authority. Now, express authority is going to be written in the agency contract between the agent and the insurer. It spells out both of their duties in writing. So express authority is written in the contract. Next is implied authority. Now, implied authority is not expressed or written in the contract, but which the agent is assumed to have in order to transact business. For your test, just think of an agent that is able to collect premiums. It's not written in their contract, but it's implied that they have that authority. Next is apparent authority, also called perceived authority, is the assumption of authority based on actions, words, or deeds of the principal, which is the insurance company. For your test, think business cards and brochures. Apparently, if you have business cards and brochures, you have the authority to do business with the company. Next, responsibilities to the applicant and insured and insurer. You as an agent have what's called a fiduciary responsibility. You are placed in a position of trust to handle funds. As part of your fiduciary responsibility, you must not commingle premiums collected with your own money. Next, we have elements of a legal contract. So for insurance contracts to be considered legal, there must be these 4 elements. First, there must be an agreement. An agreement will be made up of an offer and acceptance. There must be a definite offer by one party, and it must be accepted in its exact terms by the other. The first offer is going to be made by the applicant by completing the application and paying some premium. Acceptance occurs when an underwriter approves that prepaid application. Next element is consideration. Now, this word consideration, it is very important that you know what the word consideration means. So consideration is something of value that each party promises to the other. So consideration, something of value each party promises to the other. So first, there is consideration on part of the insured. The insured's consideration would be completing the application, so the answers on the application, how they represent themselves, as well as their payment of premium. Consideration on part of the insurer promising to pay in the event of loss. Next, insurance contracts must have a legal purpose, which means they must not be against public policy. Now, if it were life insurance, for life insurance to be considered legal, it must have insurable interest and consent. Next is competent parties. They must be of age, not high, not drunk, and they must be mentally competent to understand the contract, or it might not be considered legal in a court of law. And lastly here, insurance contracts are contracts of adhesion. The word adhesion means take it or leave it. There are no negotiations. If you don't like the insurance contract the way it's written, then don't take it. You cannot negotiate with the insurance company. Now, any ambiguities in an insurance contract will be interpreted in favor of the insured if you have to go to court. Because once again, since they're written on an adhesion basis, you can't negotiate. Then if you have to go to court, any ambiguities go in your favor. Next, insurance contracts are called personal contracts because they are between the insurance company and the individual. Insurance contracts are called aleatory contracts, which mean unequal amounts are exchanged. So you pay a little to get a lot of coverage. That's what makes all insurance contracts aleatory in nature. And lastly is unilateral. Uni meaning one, only one of the parties is legally bound. As the insured, you don't make any legally binding promises. All you do is pay your premium every month. However, if you happen to suffer a loss, then the insurer is legally bound to pay for that loss. So unilateral, only one of the parties is legally bound. Next, insurance contracts are conditional, which means certain conditions must be met by both parties. Like the insured has to pay their premium if they expect the insurer to pay for a loss. So those are conditions that would have to be met. This word indemnity, you need to know the definition of for your test, referred to as reimbursement. The word indemnity or indemnify means to make whole again, with no possibility of a gain after the loss. Just bring them back to where they were before the loss, but not to gain. This principle of utmost good faith implies there will be no fraud, misrepresentation, or concealment between the parties. All right, let's go on to representations and misrepresentations. So let's say you are doing an application on me. You ask me a question on the application. The answer I give you is a representation. It is a statement that is believed to be true, but it is not guaranteed to be true. Because what if I have a few health problems? I've already been declined by some insurance companies, but I really need some health insurance or life insurance. Do you think I might lie to you? Oh, yes, all day long, actually. If I lie to you, then my representations become misrepresentations. So misrepresentations are the lies that I would tell you, but there's two different levels. First, there are small white lies that would not affect the underwriting of the policy. Then there are big lies that would affect the underwriting of the policy. That big lie is called a material misrepresentation because it is material to the underwriting of the policy. That material misrepresentation, that statement now becomes what's called a warranty, an absolutely true statement upon which the validity of the insurance contract depends, which could be considered fraud and could void the contract. Concealment, concealing something, withholding of information that would be crucial during underwriting. So not coming out and telling a lie, just not giving all the information. All right, that is your first chapter. We have a little chapter recap here, and you should have the PDF of this to go along and look at your chapter recap. And so that will do it for your general insurance information. We will see you on the next video.